think that a day goes by that I don't get asked what is happening in this market. And let's face it, there's a lot of people who have fears about what's happening with housing prices, what's happening with interest rates. So let's keep it real. And let me just tell you that this market has definitely been keeping us on our toes on a daily basis. And today, I want to look at the facts on what happened in our local market for the month of July and discuss some projections on what we will likely see in the coming months. But also, most importantly, I want us to take a look at the true fears in our economy today, and that's of a recession and the impact that it might have on the housing market. Welcome to Kallie's Corner. Dive in with the data for the housing market in the month of July in this North Tarrant County region. So taking a look at this chart here, you can see that back since September of last year, we were hovering some over between the low 400s to 600 homes of active inventory on the market for that month. That is the number of homes available at that particular time. Now, what was significant is what happened in June as we saw that number significantly increase to over 800. And then again in July at over 1,000 homes that were available during that month. This was partly because of the number of new listings that were hitting the market, which, as you can see, really started to pick up during that second quarter and then peaking on the new listings hitting the market in June. Now, the number of homes sold stayed pretty relatively stable with a slight peak here in June. And the bottom line is this: more inventory is staying on the market. And we have shifted from less than a 1 month supply of inventory to that of about 2 month supply as of July. In other words, if no other homes hit the market, it would take about 2 months for every home to be sold. Now, don't let this concern you, because if you've been following me, you would know that we're not even in a balanced market until about 6 to 7 months supply of inventory. So we're still currently in a strong seller's market. Now let's shift to talk a little bit more about prices, home prices. Even in July, homes were selling at an average between 100 to 100% of what they were originally listed for. Now, I know some of you might question that because you probably have been seeing homes staying on the market, the days on market are longer, and the prices have been adjusting. But one must take into consideration that the homes that were closed in July actually went into contract in June, right before those interest rates really started to kick up and the market shifting. Now, as I went back and looked at those homes that are pending, meaning those homes that went into contract in July and will be closing in August, we did see that about a quarter of those listings did have a price decrease. With that being the case, and because we are still at higher inventory levels, I do believe August and September may show a more normal market with an increase to about 3 months supply of inventory. That will give buyers more power to negotiate the price. Now, I don't want to cause a panic, because hear me say this: it is still a seller's market for those of you that have a home. What we are seeing is just a slowdown in the market to that of a normal market, that of what we saw prior to the pandemic. The days of getting 100% or 110% of your asking price are not so much anymore, and sellers will be kicking themselves in the rear end if they overprice. Now is the time to make sure that you are lined up with an educated realtor that understands the market and can help you get the most when you are selling or if you are buying. Let's shift gears here a bit to those who are looking to purchase a home or maybe you're needing to sell and purchase a new home. And I know many of you have been discouraged by the increase of interest rates. So I want to spend a little bit of time covering what that means for you as a buyer by taking a look at the interest rates today and where they're going. This chart here goes back to the beginning of the year, month over month, at interest rates to help us kind of put things into perspective where we are today. And as you can see, we just saw another drop in the average 30-year fix to a 5.3 interest rate on average. But some of the confusing thing for a lot of people was the Fed's raised rates, yet we saw lower mortgage rates come out of that. And that's the interesting piece of information we want to be on top of, because when the Feds raised those rates, it brought up fears of a recession. So I want to break down what that coming recession can look like here in real estate. And no doubt, this is the biggest question on many people's minds. And I would even suggest it has become a political question. And I don't want to go down that road today and get into that, but I do want to break down what that argument is all about. So I'll start here with the National Bureau of Research, who defines a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in the real GDP, real income, employment, industrial production, and wholesale and retail sales. So, there is sort of this widely definition of 2 consecutive quarters, and I'm not suggesting we go into the politics of that, because it can be certainly interpreted differently depending on how you view the world and the politics about a recession. And those fears are certainly surging. So the question should be, how will housing be impacted by a coming recession? Well, let's take a look at this. Over the past 5 recessions, mortgage rates have fallen on average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall even after the fact, because it takes time for things to turn around when even the recession is technically over. So we can say historically, interest rates have actually fallen during a recession. So take a look here, going all the way back to the 80s. At each recession, we see the mortgage rates at the start and at the end. That's what happened. And by the way, what's happening now? These fears are starting to creep into the economy. Take a look at these headlines. CNN on July 28th of this year says, mortgage rates dropped last week as fears grew that the U.S. economy is entering a recession. And CNBC on July 29th of this year said that the drop Thursday, which was last week, also came on the heels of the Bureau of Economic Analysis Gross Domestic Product Report, a lot of words there, which showed that the U.S. economy contracted for the second quarter. That is widely accepted signal of a recession. And finally, the Washington Post on July 28th says mortgage rates are brought down by the recession fears. So we're seeing that play out in the market. And we want to provide that education to show this is typically what happens during a recession. We are seeing rates give a bit of relief actually on this recessionary period. Now, we're not out of the woods, and I'm not saying this isn't going to be a volatile market coming up, because it certainly is. And it certainly will continue to be for a while. But this is the reason for what we're seeing happen. The bottom line here, and I've spoken this before, is that recession does not equal a housing crisis. Some of you guys have seen this, and I want to get loud about it now and bring it out here again to show what a recession has done to housing prices. Now, yes, I know, 2008, we did see prices drastically affected in a negative direction during the recession. But that's because the recession was brought out because of the poor lending standards, which actually led to the recession. And I don't want to get too much into that. You can always go back and review the videos that we have done regarding what happened in 2008. But as you can see, for the past 5 recessions, it's really only been the one that has had a significant impact on prices. And we're looking at something significantly different today. So in a nutshell, and my conclusion is this: I think the biggest thing that we're seeing is a lot of fear. But when we break it down, and that's why I want to get loud about it, is because there's some understanding that we just could not sustain a market that was appreciating as fast as it has been for 2 years. We're just starting to adjust to that of a normal market. That's the normal market that we had before the pandemic. Prices are still expected to appreciate, just at a slower rate. And interest rates, yeah, they're going to fluctuate a little bit up and down. They've been doing that forever. Just know that 5.3% interest rate is not a bad deal. Ask your mother, ask your grandmother. When they purchased their home, it was probably 16% interest rates. So there you go. Do me a favor. Comment below with any questions or thoughts that you have on this topic. I'd love to hear them. But make sure to subscribe to our channel so that you can be on the up and up when we post out new content for you, so you can stay abreast of the market. Until next time, this is Kallie's Corner.